Hello and welcome back to Debit Credit Done, the podcast that makes accounting concepts easy to understand and ready for your exams. I'm your host, Dean Quartermain, and this is episode 6 of our second series on the AAT Level 3 unit, Financial Accounting, Preparing Financial Statements. So in episode 5, we looked at adjustments, and specifically accruals, prepayments, irrecoverable debts, and the allowance or provision for doubtful debts. And at the end of the episode, I set you a challenge to test your understanding. So we're going to start today's episode by just reviewing the solution to that challenge. So the challenge was then, you were given some information, it's all to do with adjustments, but you were given some information. Business's year end is the 31st of December, and you were told that rent paid during the year was £18,000. Prepayment at the 31st of December was £1,500. An irrecoverable debt to write off of £400 and an increase in provision for doubtful debts from £900 to £1,100. So the first thing we can see, we got a prepayment at the 31st of December, £1,500. Yeah. So that, from the information we're given, probably relates to rent. So we've overpaid for rent into next year. So we're going to debit prepayments for £1,500. Yeah. And credit the rent expense for £1,500. So what we've got is an asset related to prepayments for £1,500 because we have the right to receive that service at a date in the future, and we're going to reduce the rent expense in year by £1,500 because it doesn't relate to the current year. So that's step one. Step two, we're going to look at the irrecoverable debt. So we're going to write off £400 that is owed, that we've discovered is irrecoverable. So we're going to debit irrecoverable debt expense for £400, so it becomes an expense to the business, and we're going to credit trade receivables for £400. We reduce the size of the asset related to trade receivables because we're not going to receive the money. Step 3 then is to look at the provision for doubtful debts, or the allowance for doubtful debts. We've got an increase, as we're told, from £900 to £1,100. So the old provision was £900. The new provision is £1,100. The increase £200. So we're just going to journal the increase or the difference. So we're going to debit doubtful debt expense for £200 and credit the provision for doubtful debt for £200. So the end result of all of that then is the statement of profit or loss now shows rent expenses reduced by £1,500, irrecoverable debt expense of £400, and a doubtful debt expense of £200. The statement of financial position is going to show an asset related to prepayments of £1,500, the asset receivables reduced by £400, and a provision for doubtful debts increased to £1,100. So hopefully that all made sense. As I say to all students, watch the videos back, watch the previous episode back if it doesn't make sense, and then reattempt the challenge. If it still doesn't make sense, reach out to me on social media. I'm on LinkedIn, Facebook, most of the social channels. Feel free to reach out. So what we're going to look at today then is inventory valuations, and specifically going to look at different valuation methods. I'm going to talk around this thing called IAS 2 and why IAS 2 is important and how that impacts on inventory valuations. So why do inventory valuations matter? Why is it important that we can correctly measure the value of our inventory? For those who don't know, inventory is an American word. It's another word for stock. Yeah. Now, inventory is quite often the largest asset in a business, especially within retail, wholesale, and manufacturing businesses. It's the figure you put in the accounts for closing inventory is far more than just a number, because it impacts on both the profit that you report in the period and the financial position you present in the statement of financial position. So if you remember when you work out profit, just very generically, profit, revenue minus cost of sales, gross profit. further expenses, net profit. So I've got this thing called cost of sales. Now, cost of sales is made up of opening inventory plus purchases minus closing inventory. So hopefully we can see that if our closing inventory is overstated, i.e. higher than it should be, then cost of sales by implication becomes understated, i.e. what we're recording as cost of sales is actually lower than the true cost of sales. And that therefore makes profit look higher than it really is. And if profit's higher than it really is, that can mislead owners, investors, even HMRC. Yeah, because think about it, if your profit's higher, you're going to pay increased taxes. Yeah, owners might make various business decisions based on profit levels being at a certain level when actually they're not. The flip side of that then is if closing inventory is understated, then your cost of sales would be overstated and profit would look lower than it is in reality, which means you're underpaying taxes, yeah, and you're making decisions based on lower levels of profitability than you've actually got within the business. So the valuation is about far more than just maths. It's about fairness, reliability, and following accounting standards so that the figures can be trusted. So that brings me on to looking at IAS 2. Now, I don't want to talk too much about international accounting standards, within a level 3 course, but I do want to explain why it's important. So IAS 2, IAS, International Accounting Standards, IAS 2, sets out how inventory should be recognised, measured and presented. Now, there's quite a lot within that, but the bit I'm interested in today is the core rule. The core rule of IAS 2 says that inventory must be valued at the lower of cost and net realisable value. So lower of cost and net realisable value. So what is involved with cost? Now, lots of students think, well, that's just what I paid for it, the purchase price. Well, yeah, that's clearly a key component of the cost, but there's lots of other things that constitute the cost. Things like import duties, non-refundable taxes. So you've got import duties, you've got, non-refundable taxes. So not VAT, because VAT, you can claim it back. But certainly import duties are a good example of something that will add to cost. The transportation, handling and storage costs directly related to bringing goods into a sellable condition. So transport costs from a supplier, the handling cost, the storage cost of your warehouse, all that is part of the cost of your inventory. Yeah. Things that are excluded from cost, any abnormal waste, general admin cost, and any selling or distribution cost. Any selling or distribution cost are, the selling cost related to that inventory and the distribution of that inventory to the customer, that's not part of the cost, is it? And then the second part of that, so we talked about the lower of cost and net realisable value. So NRV, net realisable value. So what's that? Well, net realisable value is simply the selling price minus any cost to complete the item, minus any cost to sell it. Yeah? So that's really about what I can sell it for, minus what it's going to cost to get it into a point where I can sell it, minus any cost related to selling it. So why do we have this rule? Why does our IAS 2 bang on about this rule quite extensively? Well, it's all about the concept of prudence. Because if inventory is worth less than we paid for it, maybe because it's damaged, obsolete, selling prices have dropped, the market's changed, then you should record the inventory at the lower value. Yeah, so users of your financial accounts are not misled thinking that actually you've got higher inventory levels, higher values worth of stock than you actually do have. It's all about prudence and measuring things in a prudent way. So we're going to move on now then to look at different methods of inventory valuation. Now, at AAT Level 3, we focus on two main methods, FIFO and AVCO. Yeah? Now, both calculate costs, but in different ways. So FIFO, first in, first out. Yeah. So with first in, first out, it's very much the oldest stock cost. The costs related to the oldest stock are used first when goods are sold. Now, that's an extremely logical thing to do for perishable goods. So you think about milk, bread, fresh products. Yeah. You're very much going to want to use up the first milk. If you're a supermarket and you're buying in milk, yeah, you're going to want to use up the first milk you got first, because otherwise it's going to go off, isn't it? Yeah. So first in, first out is very logical for perishable goods, milk, bread, fresh products, fresh vegetables. But it's also widely applied in non-perishable environments for ease of record keeping. Now, there's a couple of key things. In times of rising prices, yeah, FIFO would result in lower cost of sales and higher profit, because the older, cheaper costs are matched to the current selling prices. You're using up old stock that was cheaper because prices are rising, yeah, and it's matched against current selling prices, which are higher than what they would have been because prices are rising. And the closing inventory is valued at the most recent purchase prices, which might be higher in times of inflation, yeah, or high levels of inflation. So that's FIFO. The second method that's used at level 3 is this thing called AVCO. Now, AVCO stands for average cost. Now, after every purchase, you're required to calculate your new weighted average unit cost for all the stocks you currently have. Now, every unit, regardless of when you bought it, is valued at the same average cost. So the effect of that is it smooths out any price fluctuations, and it's often used where items are identical and interchangeable. Things like chemicals, petrol. Petrol's a great example. Yeah. The thing with petrol is, petrol tanker turns up today, fills my petrol tank full of, on my forecourt full of petrol. I've got no way of saying whether the unit of petrol that's going in that car, yeah, came from that delivery or this delivery. So it's all just identical and it's interchangeable. Yeah. It's not necessarily. So you'd probably use AVCO for a petrol station. You'd probably use FIFO for, a supermarket with perishable goods, for example. Now, both those methods are allowed under IAS 2. Yeah, but the choice must be applied consistently year to year in order to aid comparability. Now, anyone who's done level 2 will say, Dean, where is LIFO? Now, LIFO, last in, first out, is a valuation method for inventory. It is a way you can value inventory. However, it can only be used in management accounts. It cannot be used in published financial statements because it doesn't comply with IAS 2. So you can use it internally, but you can't issue a set of external financial statements that are prepared where the inventory valuations are prepared using LIFO. So now we understand how to calculate the inventory valuation. We can go back to what IAS 2 says, which is that inventory should be valued at the lower of cost or net realisable value. So we're going to combine all the valuation methods with this IAS 2 rule. So let's say you've calculated your closing inventory cost using FIFO or AVCO, but you learn that the selling price has dropped due to competition. So IAS 2 says if the net realisable value is lower than the calculated cost, you must use net realisable value instead. So again, if the net realisable value is lower than the calculated cost, you must use net realisable value instead of cost. So a couple of examples then. So first example we're going to do is where the net realisable value is higher than cost. So we've calculated that the closing inventory cost is £180 and calculated net realisable value to be £200. So in this case, we're going to use the cost, 180, because that is the lower value. Yeah. Second example, the closing inventory is valued at £180 and the net realisable value is £150. Now in this case, you're going to write the value of the inventory down to the net realisable value because that is the lower amount. Yeah, so it's just important to be able to calculate closing inventory, net realisable value, and then work out which is the lower value, and that's the value of the inventory. Now, why does this matter for your exams? Well, sometimes the questions are going to ask you to calculate the cost first, so they'll say, well, inventory is valued using AVCO, calculate cost, and then they'll slip in a bit of information about things like damages, price drops, obsolete products. If you get anything in the questions about damage, obsolete products, drops in prices, it's a cue for you to check what the net realisable value is and then adjust the inventory valuation. Now, if you miss a step, the figures will be wrong in both your statement of financial position and your statement of profit or loss. Yeah, your statement of profit or loss, you've got cost of sales. That takes the closing inventory valuation and the opening inventory valuation as well. And the statement of financial position, that's got your closing inventory valuation on it. Yeah, so if you miss this step out and you value it incorrectly, it's wrong across your financial statements. And it's one of the easiest ways to lose marks. Also, one of the easiest to avoid if you stay alert to the clues around net realisable value within the questions. So if we move on then to look at a full worked comprehensive example related to inventory valuation. So let's assume that we're given the following information. Opening inventory, £2,000. Purchases, £6,500. Sales of £12,000. A closing inventory at cost of £1,800 and a net realisable value of £1,700. Well, first thing we need to do then, step one, choose the lower of cost and net realisable value. So closing inventory at cost, £1,800, net realisable value, £1,700. So the lower is the net realisable value, £1,700. Then we can calculate what cost of sales is. So cost of sales, opening inventory, £2,000, plus purchases, £6,500, minus the closing inventory, £1,700, equals £6,800. So the statement of profit or loss then would show sales, £12,000, cost of sales, £6,800, gross profit, £5,200. And the statement of financial position would show the inventory as a current asset worth £1,700. So hopefully that all makes sense. Again, if it doesn't, just rewind the video, watch it again. Reach out to me if there's any issues. So the next thing I want to just touch on then is just some tips from me as a tutor of AAT that I've seen, mistakes made on inventory valuations. There's some tips that I've come up with over the years. So first thing, always check if the net realisable value is lower than cost. If it is, ignore cost, use net realisable value. Now, if you're using FIFO, list the transactions in date order and match sales to the earliest purchases. Yeah. If you're using AVCO, recalculate the average cost after every single purchase and before processing the next sale. Round your AVCO unit cost to 2 decimal places unless the question tells you to do something other than that. Always show full workings. Yeah. Even if you make a small mistake, you can still get marks for your method, certainly in certain cases. And watch for questions that mix valuation methods with net realisable value adjustments. Yeah, you might need to do some extra work there. So a bit of a recap then on today's episode. So we've covered why inventory valuations matter. Yeah, to make sure that we've got correct valuation for stock. So we've got correct cost of sales. We're holding inventory assets at the right value. We've looked at IAS 2 rules. Yeah, the low of cost and net realisable value. All to do with prudence, ensuring we're prudent about the value of our inventory. We've looked at FIFO and AVCO valuation methods and worked through an example. We've looked how net realisable value adjustments work, and I've talked through some common exam traps and how to avoid them. Now, the challenge before Monday's episode will be on adjusting for depreciation and disposals, a combined scenario looking around depreciation and disposals, making adjustments as required. So before then, the challenge that I'm going to set at the end of this episode is as follows. A business uses FIFO inventory valuation method, and you're given the following. 1st of June, purchase of 200 units at £4 each. 8th of June, a further purchase of 100 units at £5 each. And then on the 15th of June, the company sold 250 units. The net realisable value per remaining unit is £4.20. 3 things I'd like you to do. 1, calculate cost of sales. 2, calculate closing inventory at cost and a net realisable value. And then state which of those 2 figures, cost or net realisable value, goes into the statement of financial position. So that is it then for episode 6 of Debit Credit Done. As I mentioned in episode 7, we're moving on into adjusting for depreciation and disposals. We'll look at some combined scenarios where more than one adjustment happens in the same question. Until then, keep practicing, keep reflecting, and remember, debit credit done.